Mark, it's good to see you. We have a lot to discuss today. We're talking about the biggest stories of 2022 and any predictions for 2023. I think it's tough to pick just one big economic headline for 2022. Here are my tops, though: inflation, interest rate hikes, and the collapse of crypto. So, what do you think was the biggest financial headline of the past year?
The biggest one was the Federal Reserve flexing its muscles in the fight against inflation and raising interest rates and being steadfast and really exerting their power in terms of tightening monetary policy, raising those interest rates. And you see that really starting to affect all asset prices where they are all in decline. And so it put pressure on bonds, it put pressure on stocks, really across the board for the most part. So I think the story really is, and the centerpiece is the Federal Reserve and the actions that they have been taking.
Right. And we were taking a look at those interest rate hikes, and you and I have talked before about, recession possibilities, but also just seeing the rate hike kind of shoot up like that is very significant. So I want to pivot a little bit right now and take a look at bonds, the long duration treasury bond. Here, let me get that for you. TLT, the 4-week rate of change is posting its largest reading in more than a decade, excluding the beginning of COVID. Do you see bonds making a comeback after one of the worst years in recent history for US Treasuries?
I do. And just to give further context, most of the time when stocks decline, bonds hold up very well. And that's why you have stocks and bonds making the cornerstones of a balanced portfolio. And then you just decide what percent in stocks, what percent in bonds, depending on your risk profile. This year was rare in the sense that stocks declined, but bonds declined just as much. And as of today, a little bit more. And what's happening with the long-term bond, TLT is the long-term treasury bond. That's the ETF that tracks the long-term treasuries and the price of those treasuries, is really telling you that, well, rates came from a very low level to a much higher level today. And so prices declined sharply. However, as the Federal Reserve is raising interest rates, that's putting pressure on the economy and expected to slow inflation, but also slow the economy, and possibly, and this is kind of a real strong tilt to where the narrative has gone. It's gone from inflation to now recession concern, that if we start to enter a recession at some point during 2023, the long-term treasury is going to be a beneficiary of that. And so prices are going to rise as interest rates are falling. Remember, prices and rates are inversely related. So when rates are coming down, bond prices are rising. And so I think the real key is the long-term treasury. So either the 10-year treasury that we've talked a lot about on when we've discussed as being a key benchmark, and then taking that one step further, the long-term treasury, which is kind of just an extension, a little bit more volatile extension of the 10-year treasury.
All right. So now I'd like to talk about the midterm elections and how it could affect the markets. History tells us that markets do generally prefer a divided government. I know you've mentioned that before. So I want to show you real quick a look at the S&P's annual return when a Democrat is in the White House. So according to this, does this mean we can expect a rally?
Well, we do look at cyclical analysis, and the presidential cycle has started to really exert an influence really since about 1950 or so. We went from a kind of an economic cycle to now almost a political cycle, as monetary policy has ebbed and flowed with the political cycle. So we've talked about that the midterm election year, so this past year, 2022, was actually the weakest in the 4-year presidential cycle, and the third year is the strongest of the presidential cycle. So I think what the Federal Reserve was doing while they were raising rates was really trying to front load the rate increases. So doing it in 2022 so they can start to get out of the way in 2023 as you enter the presidential cycle. And so they're not as much a part of the story, and they can play in the background and then just fine tune policy as economic data comes in. And so we'd still be very, very respectful of that third-year presidential cycle and the history that comes with it. There's never been a recession in the first 6 months of the third-year presidential cycle. So the front part of next year may surprise people, where the narrative starts to talk about recession, but a recession that actually doesn't come and doesn't come to fruition, and starts to surprise most of the pundits and investors.
Interesting. Okay. I like those insights. So last, I'd like to show you asset classes year to date, total return. Mark, this is one of the favorite things that I like to look at. So as you look at this, I know this is probably one of your least favorite questions, though. Can you make any predictions for 2023, taking what 2022 into context?
Sure, I would be mindful of how cyclical commodities can be. So the
Hmm.
price of oil is a good one, where you had a run up well above $100 and now a run back down below 100 and then towards 80, and we're in even in the $70 price range, and we're getting back to levels prior to Russia invading Ukraine. So some of the geopolitical risk and that premium was taken out of the market. Now that could come back into the market as well. And so that's one of those outliers or one of the geopolitical risks we think is out there for 2023 and 2024 to be mindful of. But at the same time, those commodity prices can move around very quickly. On the flip side, I think bond prices and bond returns would lead stocks. In other words, bond prices have to improve for stocks to stabilize and improve at this point. And so that big drawdown in bonds, and I mentioned about 18% in this chart, I would say that has to stabilize. So rates are stabilizing and then even move higher. And so that would lead stocks going forward. So those are some of the takeaways I'd look at.
Right. I like this. We will revisit this. How about 6 months into 2023?
Sounds good.
Now, this was really helpful, Mark. Thank you very much for your time.
Thanks, Aaron.